Listen up, folks. Time could be running out to lock in a historic yield at public.com. But you can lock in a 6% or higher yield with a bond account. Here's the thing. The Federal Reserve just announced a big rate cut, and the plan is for more rate cuts this year and in 2025 as well. That's good news if you're looking to buy a home, but it might not be so good for the interest you earn on your cash. So, if you want to lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade bonds, you might want to act fast. The good news? It only takes a couple of minutes to sign up at public.com. And once you lock in your yield, you can earn regular interest payments even as rates decline. Lock in a 6% or higher yield with a bond account at public.com/investing unscripted. But hurry, your yield is not locked in until you invest. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed. Not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hey friends, welcome back to Investing Unscripted, where we ask and answer the hard questions about investing. I'm Jason Hall, joined as usual by Jeff Santoro, he whom we call the voice of the people. Hey Jeff.
Hey, how are you?
I'm fantastic, and I have really good news for you.
Are you leaving the podcast?
It's the second best news that you could possibly get besides that.
We have a great guest.
Yes. That means less of me talking. I know you're happy about that, Jeff.
Anytime we have a guest on, it raises the average IQ of our podcast and keeps you from talking as much. So it's a win for everybody.
Yes, in both regards. My wife often asks when I'm talking about the podcast if it'd be possible if we could just have a guest in our home. Sometimes for the same reasons, but that's a conversation.
Well, my wife doesn't think you exist in real life. So we each have our own challenges.
I still think that's so funny. I guess, one day I'm going to corner her in the world somewhere and she's going to accuse you of hiring a crisis actor or something.
Yeah.
So
these are our goals.
Okay. Goals are good to have, whether investing or convincing your wife that your podcast partner really exists. Hey, Jeff, let's do a podcast episode. What do you say?
Let's do it.
Speaking of guests, I'd like to introduce Emmet Savage. Emmett is a longtime investor. Like a lot of people that listen to the show and a couple of the dudes that are on this show regularly, kind of got his footing as an investor with the Motley Fool, has grown from there as a professional, become an expert investor in his own right, and now helps millions of investors around the world every single day. Hey, Emmett.
Hey, how's it going, Jason and Jeff? Great to see you both.
It's great to have you on. It's been a very, very long time since you and I saw each other. We were in the green room having a cocktail before we hit record. By my math, it's been almost exactly 7 years ago since we met in person at a bar in Dublin.
That's right, in the Emerald Isle. You were over here for, what was it, 6 months, Jason?
No, a couple of months, a little over 2 months. We wanted to stay for longer, but they made us leave. I didn't commit any crimes, but so we're recording this on October 29th. Emmett, I think it's 7 years to the day, and I'm not kidding.
Wow. Actually, I just got over that. I just got over our hangover about 2 weeks ago.
Fair enough. I didn't stop drinking, so that makes it a little bit easier. So, all right, well, let's get right to it, Emmett. So, we were talking your background a little bit. I'll let you tell us more of the full background, but like a lot of us, you started with the Motley Fool, but a little bit earlier than some of us. What's your story? How did you get into investing, and then where does the Motley Fool fit into that?
Well, as you said, and thank you for the very kind introduction. I'm delighted to be here with the two of you. I was born and raised here in Dublin, Ireland, and I've lived about 90% of my life here in Ireland, with the other 10% being split between New Zealand and USA along the way, just kind of working gigs that I took along my life path. Now, strictly in my background, I'm a physicist, but I'd hate for people to hold that against me. I mean, in reality, I was born to invest in the stock market. That's my professional higher purpose in life. And along the way, because I was always so interested in the stock market, which I'll tell you a little bit about, I studied finance, which, I didn't love. I didn't love finance, even though I felt, well, that's what I need to study to be a better investor. But I did eventually study a master's in business strategy, which I completely loved. So from an academic perspective, despite having physics and finance in my background. It was only when I sat down in Trinity College in Dublin to study for a master's in business strategy that I go, oh yeah, I love this. This is great because it's drawing on the right side of the brain, whereas I think finance is drawing more on the left side of the brain. So I spent the first 17 years of my profession at the bleeding edge of communication technology until this investing thing consumed me fully. So what brought me to investing? Well, I guess that story, if I may tell it and just take a few moments. I mean, I dread to be boring, but I'm going to try and keep this relatively interesting.
Well, as Jeff would put it, it's not Jason talking.
Yeah. We're ahead of the game, Emmett. You take as much time as you want.
Well, okay, here we go. Let me bring you back to 1965, because that's actually where I've got to go to talk about the kernel of my investing life, because although I didn't arrive on the scene until 1974, really what began my passion in stock investing began long before I was born. When my father was a young man in his 20s, he got a call from an uncle of his who had emigrated to Australia in 1965 with a tip to buy shares in a business called Whim Creek, which is also the name of a small town in Western Australia that in the 60s had a history of copper mining. Now,
I was going to say, I'm going to guess this might be a mine.
Don't you know what I mean?
Yeah.
Like that's all you had. Well, I can't say that's all you had in Australia, but certainly from an investment perspective, that was the story, and it's part of the autobiography of Australia. And my father and his family, and honestly, every Irish family, had zero experience in stock investing. I mean, when I was in college, alone in the mid 60s, meeting anyone, I don't mean in college, but anyone in the wild who had bought shares on the NYSE was akin to finding a talking dog. It's like, it was like, I mean, it was an alien concept.
Yeah.
Unheard of, absolutely unheard of. So you can only imagine what it was like in the mid 1960s. But nonetheless, my dad and his siblings figured it out. Their uncle had rang home with this hot tip. It was like even using a phone from Australia, I think in the 60s, in its own right, you'd look at the phone and go, wow, that person's on Australia. But anyway, they bought into the company, they bought shares, and somehow they figured out how to track its price performance. It rose marginally and the share price stalled. Now, his uncle was very clear on that phone call. He said, don't sell until I ring you again. But after a while, the phone hadn't rang and they were keeping an eye, and the stock had drifted up a bit and the phone wasn't ringing. So they decided, that's it, we're cashing in, we're done. He lost our phone number, we're just going to sell these shares. And it was after that, wouldn't you know, Whim Creek started to rocket. And sure enough, you know, my dad's uncle rang, whatever it was, months or years later, and said, okay, sell now. But it was too late. You know, at that point, they dumped the shares. But what had really happened, and what clicked in my own father's head, was that here's a mechanism for creating wealth out of thin air. Now,
right.
we're all mature investors here, and we know that that's not quite the truth. But certainly, when it is akin to magic, you know, it left him thinking. And so fast forward a few decades, as I said, I arrived on scene in the 1970s, and in the 1990s, the internet came into everybody's home around the world. We all got a dial-up modem, traditional brokers went online, and in a short time, every person gained access to the biggest capital market in the world, which of course is the US stock market. And this is compared to me buying my first share, which was DELL. And when I dialed New York to buy my first share ever, the broker's name was, I think, Payne Weber, and the commission to buy one share in DELL was $80, and I bought $70 worth of shares. So I paid it. So like this was, you can just imagine, we don't need to debate and discuss how the internet has torn down every barrier to entry, but I began to invest in stocks as a hobby online almost 30 years ago. And it was at that point that I was studying applied physics, but that passion, that my true passion was stock investing. And about halfway through my degree in around 94, before Google was ever born, or before Facebook, long before Facebook was born, I started a blog on Yahoo's GeoCities, which was a website for, you guys might remember it. but
I'm
it
old
was
enough to remember. Yeah.
right, exactly. So GeoCities about stock investing. And again, back to that, to have an Irish guy writing every day about stock investing, an Irish guy studying physics, on a blog. This was just come on, this guy.
It's a polka dotted dog who could talk.
It's a freak show, it's a circus act. It's like, look at the physicist writing words about stock markets. But anyway, sites like the Motley Fool came into my line of sight, which was born in and around the same time. And I could get guidance I could buy shares online for $10 a trade. In the US, my first broker was Daytech. And I'm sure a lot of your listeners go, yeah, look, that's everybody's story, because it is everybody's story. I'm 49 years old, and anyone who's 49 lived this. So far, this is by no means a unique story. And a few years later, I started writing about I moved my stock ideas to the Motley Fool's discussion boards, which really meant I was reading and learning as I was doing. And I formed some friendships in that community. And by 2001, 2002, thanks to the dot-com bubble, as with most of your listeners, I'd lived most of the major lessons I had to learn about stock investing. I'd borrowed to the teeth on margins. I'd clicked a couple of buttons that said, yes, I approve to buy more shares. And off I went to the market with a new bag of money, and, I lost my shirt. And in the run up to that, the borrowing to buy, it's suddenly that boundary between investing and gambling becomes very blurred when you're a young 20-something-year-old.
But that's the time, Emmett, that's the time to make those mistakes, is when the stakes are low, right? Versus when you're in your mid 40s, you're getting into your peak earnings years, you've got a couple $100,000 in a 401k, you change your jobs, you roll it over to your broker, the market's going crazy, it's 2020, and then you margin up, right? And you literally wipe out everything, right? You learn that in your 20s versus your 40s, right?
It's a blessing if that happens. You're right. I mean, I was listening to rumors. I leveraged up and up and up, and next thing I could borrow more to buy on margins. But while I lost every penny, the real gift was I was 26 when all of this, palace of ice melted. And so like by mid 26, I was back where I started, but at least I had a good job, I had a professional engineering job, and I'd given up all these gains. I mean, on paper, I had more wealth than I expected to have saved by the time I'm my age now. I couldn't believe this big number in front of my eyes, but it all disintegrated. But what happened then was I decided, and I commit myself to learning properly, which is around that time where I said, oh, I better go study finance. And as I mentioned, I didn't love that. But really what I took from this was the stock market is a mechanism that can take any normal person from a suburb in Dublin through to a suburb in Auckland in New Zealand, through to them living in Midtown Manhattan, from modest beginnings, and transform their future if done right. And it is there is nothing like it. And I just have evangelized the power of investing, as the two of you have done. And there's only a handful of rules. Once you diversify, don't borrow to buy, go long, add a little often, and a few other rules that are codified into your conversations in the podcast after podcast. It's difficult to go wrong. It's not impossible, but these fundamental rules and guide rails are coded into everything my Wall Street and I do.
It's funny when you tell that story, what it reminds me of is what a fun and very different vibe the internet was in the 90s versus now. And, we're going to sound like three old guys, talking about the good old days, but I can imagine, I wasn't into investing back then, but I certainly remember what it was like when online discussion boards
were you into high school back then?
I'm not that much younger than you guys. All right.
It's true. It's true.
People probably think I do because I spend most of the time on this podcast talking about how old you are, Jason. But we all experienced the internet around the same time in our lives. And I think that it's funny. We talk a lot on this show about the blessing and the curse of the internet now, where you can get literally anything you want to find out within seconds, but then you can also get anything you want to find out within seconds. So there's like a good and a bad of that. But back then, when these online discussion boards were brand new, it was so just exciting to be like, oh wow, I'm typing on a computer and talking to someone in Ireland. That really blew my mind when I was when I was a teenager and in my 20s. So I can imagine it would be just as easy then as it is now to get caught up in something like investing because you find this little community, lose your shirt. So I guess I guess my point is like that's a story as old as time in a lot
It
of ways.
is, and it's intoxicating feeling. Like I'm sure people, even now today in the year 2024, when you make a cell phone call from your car and talk to somebody on the other side of the world, very few people don't for a moment go, that's pretty cool. I'm driving my car on a motorway and I've just spoken to my friend in Alexandria, Virginia, or in Main Street, Sydney. Yeah,
Right.
wow, I'm driving a car and he's in this coffee shop in Sydney. We all marvel at technology.
And space was involved. Space was involved in your communication, right? Satellites move that signal. It's incredible.
Pressure, fiber optic, copper wire. I mean, every element on the periodic table of elements was involved in you talking with this person. So you're right. You're on the money, Jeff.
Yeah.
I mean, back in the day, there was something akin to magic where you're like, wow. And in fact, one of the Yahoo was the hot space for free discussion boards, Yahoo Finance. And the Motley Fool was the hot space for, I suppose, moderated, somewhat far more controlled and mannerly conversation.
Mm-hmm.
And Yahoo Finance would descend into an abyss, a cesspit. But it like things would happen. Like, for example, if I hope I haven't, we might fact check this, guys, but I think the founding CEO of Whole Foods is a guy called John Mackey. And if I'm not mistaken, he was pumping.
Yes.
Whole Foods
he had
stock.
An anonymous username and he was pumping his stock. He was trying to counter other stuff. He was abusive. It was like he got in trouble. Like he got in proper
trouble. It was a proper Martha
trouble.
It was Martha Stewart-esque. I don't think he did time, but he certainly was there. And when you found like, I'm just a young guy and I've been chatting to the founder of Whole Foods here in Ireland, like all of this kind of added to the mystique, the dark. Like, so it was a very exciting time, but there was nothing more exciting than putting down $100 and finding, based on nothing whatsoever in the late 90s, that $100 returned to $1,000 in a matter of weeks, just based on the hot air hype that floated the balloon. That was the .com.
Oh yeah. Some of the metrics, website traffic, you know, these were metrics that companies would float. And when they talk to investors, the things that they would talk about were incredible. Revenue was a pipe dream. It was amazing.
It was. And you're so true. I mean, having founded my Wall Street, I also have lived the fool's trap of vanity metrics. Yeah. Because every company has a line that's growing up, that's growing fast, whether it's exponential or it's the Nike swoosh or whatever way they have something. And very easy to point at that when you're talking to others going, look, amount of things we've got going on this particular metric. And everyone's like, wow, if this person's telling me it's important, it must be, I want to invest. And that was like on steroids in the late 90s.
I like that. And I like that phrase though, vanity metric. Like I feel like that could be a filter for individual investors. Like find any company's vanity metric and then take it with a grain of salt.
This is true. I think that's a good one. I think you're onto something there, Jeff, because you're right. Every IR deck you eventually realize has some vanity metric.
Yeah.
You know, it's
because they're going to highlight the best part of the business.
Well, here's a hint, Jeff. Here's a hint to knowing which one it is. It's the one they changed when it's not good enough anymore.
It's the one that disappears when it slows down.
Yeah. Well, isn't that funny? Because even like Netflix now have announced, as I'm sure you guys well know, they're no longer going to talk customer numbers. But what was quite interesting is they are not going out with a fizzle. Their last customer numbers were explosive. And they announced we're not going to. So it's very cool. It's a casual flex where they're like, we're not going to talk customer numbers anymore.
They're so good, we don't even need to talk about it.
Yeah, like, oh, look, we just upped it by 15%. Whoops. I tell you, we'll just talk metric. We'll just talk money from here on in. And you're right. Yeah. So it is till it isn't.
Right. You know? Right. No, that's interesting.
Hey, everybody. We'll be right back. But first, a word from our sponsors. FinChat.io is the complete stock research platform for fundamental investors. They have all the standard financial data on more than 100,000 stocks globally. But beyond that, they have company-specific segment and KPI data on around 1,800 stocks. So for example, do you want to see NVIDIA's data center revenue growth? They've got it. Do you like to track Apple's iPhone sales? They've got that too. Or how about nights and experiences booked for Airbnb? You guessed it, they've got it. And they just added around 8,000 ETFs and mutual funds to the platform. The breadth of FinChat's data is truly one of a kind. I use FinChat every single day as I'm researching the stocks in my portfolio, specifically when I want to see how they're doing on KPIs that FinChat is famous for. So to get 15% off any paid plan, go to finchat.io/unscripted. That's finchat.io/unscripted to get 15% off any paid plan today. The link will be in the show notes. Hey, Investing Unscripted listeners, this episode is brought to you by our friends at Yellow Brick Investing. Yellow Brick is an aggregator of the best stock pitches across the internet. By tracking thousands of blogs, newsletters, fund letters, podcasts, and more, they're able to collect and summarize the best stock pitches from all over and bring them to you in one single place. Think of it like a modern value investors club. I have to say, this is pretty cool. I can just type in the company I'm interested in and get a bunch of different stock pitches from across the internet. It helps me think through new ideas and find opposing points of view on the stocks I'm interested in. And the best part is, access to Yellowbrick is completely free. Try it for yourself. Simply go to joinyellowbrick.com and search a company or ticker you're interested in. You're bound to find a great report on just about any company. That's joinyellowbrick.com.
So Emmett, let's pivot the conversation a little bit here. So talking about that, going through that period, the .com bubble and then the crash, and a lot of years of kind of wandering the desert for the market, but also I think it's interesting too, thinking about your timeline, being in your mid-20s, sort of hitting restart. You're in a good position, good job, earning. You've learned that you made mistakes and not that the market was rigged, right? So you learned the right lessons. I think that's an important thing to stress there. Let's talk about the next period of your professional life ramping up. So you get the point where now you have expertise, you've learned, you can look back and you say, you know what, I'm a veteran now. I know what I'm doing. I can start helping other people. And this is an opportunity for me as an entrepreneur. You found the predecessor to what is now My Wall Street. Let's talk about that journey.
Yeah. Well, the origins of My Wall Street goes back to a small advert that I placed in the Irish Times newspaper about 20 years ago. And it simply said something like, if you want to learn everything you need to know about stock investing, come to this hotel at this time. And if you're not 100% satisfied, don't pay. And at that time, I was heading up the radio engineering function for a large telecom operator, as I said. And this hobby of mine was too big to ignore. It was just bigger than my interest in my day job, which means you really have to start to think about your day job.
So for context, for some of our younger listeners, yes, it used to be completely normal and not weird or creepy to advertise for people to meet you in a hotel room in a major news publication.
Now, what I have to make clear, it was a conference room.
It wasn't Emmett's personal.
It was a classroom, but they so happened to have a hotel around it. It wasn't, there was nothing Hollywood about
Room
it.
123.
Yes, Your Honor, I insist. I swear to God, I thought there'd be loads of people there. But, you know, what really pushed me to accept that my passion was bigger than my profession and really was the birth of My Wall Street. My Wall Street was founded in October 2013, so it's 11 years old at this stage. But what really pushed me over the edge to set it up was one word, which was belief. And the backing and belief of others is key, is absolutely key to anyone doing anything. I mean, I'm brave, but I'm not that brave. I read a piece in the Harvard Business Review a few years ago about the attributes of true entrepreneurs. And as probably all know, MBA courses will have you believe that there's resilience and entrepreneurs have the ability to get back up when they've been knocked down, and they're generally optimistic and they only envisage a better future and blah, 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 blah. All of that is true. However, this Harvard Business Review piece also said that almost every successful entrepreneur, from Henry Ford through to Mark Zuckerberg, had someone at their back, whether it's a life partner, a husband, a wife, a mother, a father, who just says to them, you can do this. You can do it. And that's an incredibly powerful feeling, because really decisions are a consequence of our feelings as opposed to data. You know, we act on our feelings. So that's
Emmett, you're welcome. I'm so glad that
and I really, it's just, I hope you got the flowers. I mean, hold on, is that your doorbell ringing?
To be clear, it was not me. Yes, I've always believed in you, Emmett, but it was not. Indeed, it was not me. But no,
Well, you always had my back, but for sure. But this was a couple of years before we met,
yes.
and but you know what? You can have it. I mean, what the hell? Nobody else listens to me. You can have the.
No, I
Well,
think
you
it's
know,
interesting though.
yeah.
And I think that's true. But I think there's also, and maybe I'm overgeneralizing here, but
Mm.
it feels like one of the things that I've seen too is that a lot of businesses, startups particularly, that get big, there wasn't a lot of belief when they were small. Maybe people
Mhm.
thought that the founder was crazy, walking away from a really good job,
Yeah.
that you're set for life, right? You just keep doing that and what are you doing? Like you're
Yeah.
crazy for doing this. And a lot of times those are the ones that turn out to be successful ventures in the long term. And a lot of times the seems like maybe the inverse of that can be true too.
Mhm.
Somebody's a really good cook and they throw great parties and somebody tells them they should open a restaurant and 2 years later they have no money and no restaurant, right?
Yeah,
Um,
that's true. I mean, I think the nature of the human condition is we will hear more about successes, especially in, let's say, the Silicon Valley world.
yeah,
We open a newspaper or magazine or online, and we read about the successes. We don't read about the graveyard of failed efforts. That,
that's true.
you
That's
know,
true.
that chef who
And there
was
are
told
lots of
by,
them.
yeah, well, for sure. That chef who was told by his mom that he makes the best bolognese ever and he should open a restaurant. Like, you're dead right. There's so many entrepreneurs who gave it a shot and that shot didn't work out. But I am one of those people who don't believe in the word failure, because if everybody sets out with the right intent, nobody's going to start something with the wrong intent. They might make suboptimal decisions, or they
Yeah.
might, right from what industry they're choosing to whom they decide to surround themselves with. But really, that we hear about the successes. So Mark Zuckerberg's name falls off everybody's lips, but his cousin Throckmorton Zuckerberg is the unheard of guy who started a shoe factory that didn't work out or whatever. But
Right.
this,
Right.
so the second kind of element to success is, apart from having somebody who says you can do it and I've got your back, is, I believe, a co-founder who complements your weaker areas with strengths, because no one person is good at everything. If you're a remarkably big visionary, you're going to find reading legal contracts an absolute bore. And you got to find someone who's really good at operations if you're very good at strategy and vision. If you are somebody who loves the limelight, you got to find somebody who hates it. I mean, I'm pulling examples out of thin air, but when I set up
Right.
this business, my wife and I sat down and she said, here, she got a big sheet of paper and she said, I want you to write down the name of everybody you've ever worked with whose work ethos you just admired. She said, I don't care if it's the person who's emptying the waste paper basket in your office and they just, they do it better than the other people, or if it's, someone who's running the local barista, right through to the CEO of the local CEO of Pepsi. You just write down everybody whose work ethos you've admired for whatever reason. So I wrote it down. She wrote down her names. She said, now put beside all of those names, she put down 4 categories. And I think one was visionary, artistic, operational, and something else. I can't remember what the other one was, but she said, put 2 labels against your name. She wrote my name in the middle. What 2 are you? And then give everybody else 2 of those labels. And by the end, there were 3 names out of about 40 that were the opposite of mine. And there was one name that just jumped out. So I walked up to John Tyrrell, the co-founder of my Wall Street. I
Mhm.
said, hey, John, I'm going to get out of this joint. I'm leaving Vodafone. Would you join me? I'm going to found a business. Here's the mission. The mission is to get the world investing successfully. That's all I know. And he said, And I said, we're going to create 1 billion successful investors, and it's going to take more than life we've got left in our body. So it's going to take longer than we're going to live. So I said, that's from there on in, we've got to figure it. And he said, I'll be back to you. And he went home, spoke to his wife. She said, I have your back, as my wife said to me. And he met me the next day and he said, let's do it. And that was the beginning. We hopped in a plane. We flew to Alexandria, Virginia. We walked into the Motley Fool. I met one of the senior leaders in there who I had a great relationship with. And he said, we've got your back and we'll invest. And that was like a goosebumps moment, because, like, to be honest, when somebody says they have your back in all these different ways, the way John Tyrrell said to me, the way my wife said to me, and the way the Motley Fool and the key people in there who made that decision said to me, you feel power charged. You feel ready to take on the world. You feel like a bull in a global china shop.
That's wonderful.
It's great story. I love that.
My takeaway from that is you need a great idea, somebody that can do all the stuff you can't, somebody else's money, and wives that won't leave you.
But all of that is true. But what's quite interesting is that people and money will not get you a great idea.
Yeah.
But a great idea will get you people and money.
Yeah. There you go.
Actually, a great idea won't always get you great people, but certainly in the hierarchy, cash will follow the people and follow the passion and the idea.
Yeah.
So,
yeah,
I once spoke to a young entrepreneur and he pitched to me his business idea, which was nice, but he was thinking small. And I said to him, look, if I was opening a coffee shop tomorrow, I would not say, hey, I'm opening a coffee shop on Grafton Street, which is the main kind of, as you know, Jason, the main shopping street in Dublin. I wouldn't say, we're out opening a coffee shop on Grafton Street opposite Bewley's, and our angle is if you wear glasses, you get a balloon. I wouldn't say that. I would say, we're opening a coffee shop on Grafton Street in Dublin, and in 8 years, we're going to take down Starbucks. And if they don't invest in us, they're going to be sorry. And we're going to go out to Ethiopia and buy as much coffee as they will sell to us. And by saying that, a lot of different things happen. One, the person who's listening realizes you're either a maniac, a deluded maniac, and they better back you.
Right.
Because if this crazy guy is right, I'll have missed investing in the next Starbucks. So there's just, to entrepreneurs, get a picture of what it is you want to do. And when you tell the story, multiply it by 1,000, because someday that will happen. I spoke to Reed Hastings, I'd say 20 years ago. One of the best decisions I made in my life was to buy shares on Netflix at a very, 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 very early stage at $1.20 a pop. And the reason I bought shares in it was, and thankfully didn't sell, that's the casual flex. Oh, sorry, guys, that's my 300. Excuse my 375 bagger. I just haven't. But I'll pick up that name I dropped. But like he at the time was saying, we're going to have 20 million customers, and I was like, 20 million? There isn't even 20 million people on the planet, you crazy thing. So like, this is kind. And at that time, there was him talking big. So I mean, this is the thing to entrepreneurs everywhere. When you multiply your dream by 1,000, you, as you are saying, it will blush for the first while because you know it's crazy. For me to say we're going to create 1 billion investors, there's a voice in my head knowing, that I'm not Zoolander. I know that's 1 in 7 people, and I understand the dynamics and language barriers of this planet. I've looked at it a little bit, but it's really only there to articulate what you're trying to achieve. Whether you achieve it or not, that's another thing.
Well, it's funny because Elon Musk, and I'll be honest, in a lot of ways, I'm not a fan of Elon Musk, but the thing that I admire the most about him is, as much as the financial media bashes Tesla for missing targets and deadlines and goals, he sets audacious goals. And even if they take twice as long to reach them, they have done incredible things, right? So there is something for that to be said for that audacity as a founder, as a visionary.
Yeah, completely agree with that.
Yeah. And the other thing too is in so many aspects of life, whether you're an entrepreneur, whether you are just CEO of a company, or even in my day job, Emmett, I work in a school district, and in education, having a clear goal for a lesson you're teaching or something you're trying to accomplish within your classroom is the surest way to ensure that kids will learn something. So I love finding places outside of my profession where just being goal oriented, where will I be 10 years from now? Where will I be 20 years from now? Where will I be at the end of this 40-minute class with these kids is such a clarifying moment to have in your own head. And then a lot of times it helps all the pieces kind of come together, and it drives all the decisions you have to make moving forward. Because like do I do this or that? Well, which one gets me to that goal? Do I do this or that? Well, which one gets me to that goal? So
Yeah, I love
that's a
that.
connection I made.
So I love that because I mean, when you think about teaching, the higher purpose of teaching is you know that when you teach, you're going to touch a life forever. If you do it well, that little person or that not so little person is going to have a better outcome in their entire life because of your job. There's the higher purpose. And then you bring it right back down to the KPIs of the week. And they're like, well, we got to teach this kid, whether it's the alphabet or third order nonlinear differential equations, whatever, that that thing
Hopefully
is.
not the same kid, because that.
Oh yeah, well this is true. Yeah, so and that's where like that co-founder back to John, like where he will feel me out to paint the big picture, and then he'll stand in quickly and go, and here's the KPIs for the quarter. Where I'm like, what? So there's a kind of a necessity to have those two frames of reference very clear, and also remember that no matter who you're speaking to, they're not listening for long. And but you'll only bring somebody in by short, succinct messages or being the most charismatic speaker, that you can imagine.
So you mentioned that the original goal was to make a billion investors or teach a billion investors how to invest. I forget exactly how you framed it when you mentioned it a few minutes ago. So I want to pivot the conversation a little bit to maybe ways you think about how new investors should step into that, right? So you told your origin story of the early days of the internet and making connections across the world and doing a lot of dumb things. And thankfully it was at a time in your life when you could do that and not, bankrupt your future. And we talk a lot on the podcast about newish investors and people who are on that learning journey for themselves in a different context here in 2024. So I guess that my question is, what are some tried and true things that you think like a newish investor, maybe not day one, but maybe in the first 6 months, the first year, should kind of keep in mind as they step into their own journey?
I love that question because to me, there are 6 golden rules for an investor, irrespective of whether they only heard about the stock market today for the first time or whether they've sat on the sidelines for 30 years and decided today is the day. And before I tell you those 6, which I'd love to hear if you agree or think it's missing one, but when we founded My Wall Street, the government said, here's some money to spend on academics to help you do research on the market opportunity. And we ended up collaborating with a couple of universities in America to understand why doesn't everybody invest in the stock market? Why isn't it just 100% of everybody does it? And the university said about this very academic study of that phenomenon and why doesn't everyone give it a shot? And they boiled down the barriers to only 2 categories. One was emotional and the other was rational. So people who do not invest have either a ball of emotional concerns, which is worried about losing money. I don't know anybody else who did it. My mother never did it. My father never did it. And they're emotional. And then there's rational things like, what broker should I choose? What should be my first share? How much should I invest? They're all binary answers. And when you break out the barriers, they almost fall into just 2 silos. So when we founded the business, we wanted to have a formula that effectively addressed the greater ball of problems that exist in everyone's mind, because we're all just a big old complex wired system of biases. Like this.
Did you get a sense, or in that research, did anything come through that told you the how much those 2 factors, like was one of those factors the bigger barrier than the other? Because my assumption with having no background in this is that the psychological pieces of it are the bigger barrier than simply the what brokerage do I choose?
Entirely. The emotion had about an 85% weighting. And the number one dead weight in that was fear of losing money. I don't want to put $1,000 down and find it's $80 in 6 months. Even if you've just told me I bought the next DELL. And I always choose that example because it was DELL that literally flipped a switch in my head to never be unswitched again. And was that I realized at the end of 1999 that DELL shares had gone up 1,600 fold in the 10 years from the first day of January 1990 to the last day of December 1999. It went up 1,600 fold. So $2,000 investment turned to $3.2 million. To me, this was like, no, No, that can't be true. That can't be right. But it is right. So that's great story to get someone excited. And you could tell someone they've bought the next DELL, but they don't like it if they put $1,000 in and it's only worth $100 now. Even if you sell, this is all the attributes of DELL. It's going to be the next DELL. This is the next big thing. I promise. People hate that. That's the greatest emotional dead weight. But I've drifted from your question. I mean, your question is a simple framework for an early stage investor. 6 rules. Let me hit you. Number 1 is very simple. Get started. So whether it's your first day, everybody has a relationship with their first, whether it's their first meaningful relationship, the first album they bought, if you're mine and Jason's age, Jeff, the first, whether you subscribe to Spotify, Apple Music.
No, hey, I'm old enough to have cassette tapes and everything. I'm there.
There you go. So your first day at the gym, first day at college, firsts have we all fuse a relationship in our mind. Doesn't mean it's the first is the best. It's rarely the case. But number 1 was just get started. Second is just think long term. Like if you go in with this buy and hold philosophy in the knowledge that it outperforms the market over the long term, you are already gearing yourself. So decide you're starting and decide you're just going to let it burn away in the background for the very long term. The third rule, so get started, think long term. Third rule is never borrow money to buy. Just, we can explain why, but us gray-haired guys will show you why. I mean, the annihilation of
Call that the Emmet
wealth.
rule.
Call it the Emmet rule. I mean, your broker goes, you want some more cash? I got it over here. You want it? It's all going to go up. It's going to be right. And it's kind of like, that is like never, ever borrow money to buy. It's a double-edged sword. What goes up comes down, and leverage really hurts on the way down. And for your very, very early stage investors, just to explain, if your broker loans you $1,000 and your folio is worth $3,000, but the market crashes and your folio falls to $1,500, you still owe them $1,000. And that kind of is, when it's a lived experience, it hurts. So the third rule is never borrow to buy. So in other words, invest within your means. Fourth rule is diversify. I always say a minimum of 12 stocks across different markets and sectors. The fifth rule is buy what you believe in. You should not own an asset if you don't fundamentally just even like it or understand it, have a hunch. And the fifth rule is invest what you can when you can. So the nice thing about stock market is you can throw $50 at it once a month and it doesn't ask for any more. If you buy a property as an investment, which has been historically an Irish sport, because in Ireland, certainly up until about 10 years ago, the word investment was just a proxy for buying a property or buying a piece of land, but it demands a lot more from you. If you own an apartment, you're going to know what a demanding investment is. Whereas if you buy a share, you can buy $50 more in a month or $50 in a half year. And so get started, think long term, never borrow to buy, diversify, buy what you believe in, and invest what you can when you can, because this is the most beautiful sport in the world. There's nothing like stock investing.
Hey, everybody, we'll be right back, but first a word from our sponsors. Heads up, folks, interest rates are falling, but you can still lock in a 6% or higher yield with a diversified portfolio of high yield and investment grade corporate bonds on public.com. You might want to act fast because your yield isn't locked in until the time of purchase. Lock in a 6% or higher yield with a bond account only at public.com/investing unscripted. Brought to you by Public Investing, member FINRA and SIPC. As of 9/26/24, the average annualized yield to worst across the bond account is greater than 6%. Yield to worst is not guaranteed, not an investment recommendation. All investing involves risk. Visit public.com/disclosures/bond-account for more info.
Hey, Investing Unscripted listeners. My name is Brett, one of the hosts of the Chit Chat Stocks podcast. If you love Investing Unscripted, we think you will love listening to Chit Chat Stocks. On our show, we research individual stocks, interview investing experts, and, well, chit-chat about investing every single week. From hot stocks such as NVIDIA and Celsius to hidden small-cap gems, we have something for every type of investor. Follow the Chit Chat Stocks podcast on YouTube, Spotify, or Apple Podcasts, and start discovering new investments today.
The one that you said that jumped out to me is I have a family member. I've told this story on the podcast before, but obviously you've not been here yet, so I'll tell it to you. I have a family member who has always been investing in stocks just a little bit throughout her life. And she would only buy one or two or three different stocks at any given time. So there was no diversification. And because she's older than me, she was investing all through like the .com time and all that stuff. And the story that she tells all the time is she bought Cisco, like, I don't want to say literally because that gets overused, but pretty much at the top of the huge spike in 99 or 2000, whenever it was. And I don't think to this day it has regained.
No, it
yeah,
hasn't.
probably not.
So,
It hasn't.
and
No.
it's the story she tells me all the time and why she still does a little investing, but she's so scared to lose money because that is
Yep.
that's her understanding of the stock market. And, as I've gone on this journey myself over the last couple of years of learning a lot, I've been trying to tell her, like, that's not, you can avoid like the ruinous aspects of that by just
Yes.
owning more.
And one of the golden rules that I think, it's not quite a rule, but if we're going to talk about six rules, one that isn't quite a rule, and it's a little bit culturally outdated wording, but there's no angels on Wall Street. Nobody remembers what you paid for a stock except you. So there's no higher power waiting to pay you back what you're owed. And a real cognitive bias, I believe, is knowing I paid $100 for this stock and now it's worth $3. And I'm not going to sell until it's $100 because that's the way it works. Well,
Yeah.
I'm sorry. That voice is inside your head. And occasionally we make bad decisions. And for every great decision I've made, there, as I said earlier, is a barren wasteland of atrocious decisions in my wake.
Yeah. It's amazing how we do compound one bad decision by another bad decision.
Yeah.
That one in particular really sticks with me, Emmett. The idea that something that you've acknowledged sucks and that you don't want to own anymore, you think it's going to go back up
Yeah.
to what you sold it for? Yeah, it doesn't.
Yeah.
So I think what I like, we talk a lot on the podcast about having frameworks, and this is the point I was trying to get to when I was telling
Yeah.
the story about my family member. If you're new to investing and you don't have some sort of guidelines, you will make one of the mistakes that your 6 kind of points prevent you from making, right? But this is Jason's phrase, but I'll steal it. We like talking about frameworks, not rules, because the frameworks make you think and rules just tell you what to do. So I love the fact that you have this like really simple kind of 6-point framework to just
Totally.
guide people towards, and then you learn over time and you decide which of those 6 you think are most important or least important, or maybe you would add one or take one away. The one that you had on your list that resonated with me, we just talked about this, I think, on the last episode or maybe 2 episodes ago, the idea of liking what you own. And
Yeah.
someone asked us a mailbag question about basically sin stock investing. Like, how do you feel about investing in industries or stocks that you don't really believe in what they do? And,
Sure.
we went back and forth about, well, there's 2 ways to look at it. You can take all those profits and do good with them. You can get really rich off of tobacco stocks and then go donate to the American Cancer Society. Or you can just avoid them entirely because you don't want to be
Totally.
invested in them. And I personally, there's no nevers in my philosophy, but I don't want to own things I can't root for. That's the way I answered
Totally.
the question. Like,
Buy what you
that makes
believe
it less
in.
fun.
Yeah. But to
No,
your family member sorry, John, but to buy what you believe in would actually, if your family member was committed to that and you said to her, oh, guess what? Your broker accidentally sold your shares in Cisco. Here's the spoils of the sale to $5,000. Do you want me to tell them to buy Cisco again? There's a reasonable chance that she would go, I don't know. What do you think? You said, well, I actually prefer this opportunity over here, even though in this kind of perfectly liquid game that we're playing, it's almost a thought hack for that cognitive bias, because if she doesn't believe in Cisco, if her broker accidentally sold those shares and said, hey, you want to buy it again? And she said, no, well, then she doesn't believe in it. And I think, that in that situation, that worked example, she didn't believe in Cisco. She just wanted them to pay her back what she believed was owed.
Yeah. That's a good point.
I think this is a good follow-up to that question that we got, Jeff, because one of the things that we didn't say that I was thinking about after the fact, and Emmett, this really kind of brought it home for me, especially when you were talking about it, is I don't like the idea of arbitrarily limiting your pool of potential investments. It's hard enough as it is to find great stocks. And if you limit areas for ethical reasons, it makes it even harder, but it definitely risks having borrowed conviction. And that's a terrible way to invest and a great way to find more losses. So I'm glad you brought that up. Jeff, I think we're running kind of out of time here. We got a couple questions, lightning round questions we can get to. And Emmett, we need to give you a chance to fully pitch what you're offering.
We talked a lot about My Wall Street, but I don't know that we've ever given you the opportunity to like truly pitch what it is and why people should check it out. So why don't we start there?
Oh, well, you gave me plenty of opportunity there. I mean, our mission is to get the world investing successfully. And as I said to you just when we were backstage in the green room, our app is on millions of devices around the world. So if you want to learn how to invest, just download the Learn by My Wall Street app. We ask for nothing whatsoever.
Yep, and you'll see it in the show description. You'll see it in the transcript as well. My Wall Street, one word. Street is the abbreviation STMY Wall ST. Easy to find. It's the most popular app with that name you'll find in the app stores.
So all I ask for your listeners is go follow me on Twitter. It's Emmet L, EMMETL Savage, and you'll see a pinned tweet on the top with a photograph of my TD Ameritrade account, or sorry, I mean to say Schwab bought TD Ameritrade, my Schwab account from about a month ago, which shows my best investments. And I've been fortunate enough to have several hundred baggers, but believe me, I've had a hell of a lot of bad mistakes. So the only two asks I have is follow me on Twitter. And if your listeners are enjoying investing unscripted, and be odd if they got this deep in the podcast and they're not, why not? Why not listen to Stock Club? So Stock Club is my podcast, and I believe that listeners of Investing Unscripted would enjoy Stock Club equally as much. And my co-hosts and I talk about stock market, the US stock market, every week. And it is our love and our passion, as it is yours, Jason and Jeff. So please listen to Stock Club. It's on all good podcast store near you.
Awesome.
All right, I have a question for you here. We got this is a short lightning round here. The first question, you already gave us an answer. We know a couple of your best multi-hundred bagger stocks. What's your worst individual stock buying decision?
Oh, well, I've had so many stocks and businesses that just went bust, so I could list them all. But I think the greatest loss I suffered where I took a decision and clicked the button was a business called Superconductor Technologies, which was down 99.9%. It would have to grow 1,000-fold to pay me back what it owed me. So I'm going to put Superconductor as my worst investment per se. But let me just tell you one other thing. It's not lightning. The worst decisions I've made as a collective group were all sell decisions.
Yeah. Usually selling too soon.
Selling too soon.
Yeah.
Oh, I sold Mercado Libre 17 years ago.
Oof.
I mean, yeah.
I might have bought it from you.
Yeah, I hope you did.
Still holding. I am. Jeff, do you have one last question?
Yes. This isn't really a lightning round one either, but we just talked about this. So I'm curious what your take is. We did an episode a couple weeks ago about asking the question, how much research is too much research?
Mm.
So where do you fall on that spectrum? Do you think you can actually spend so much time learning about a stock or a business that it actually becomes an impediment to making good decisions?
Yeah, because the day you know least about a business you own is the day you've bought it, because that's day one. Everything you've done up until that point is academic. It's so odd that as you follow your investments and hopefully hold them for tens or dozens of years, that the day you actually know least about this company is the day you've bought it. Now, when you've gotten to that point, you've satisfied a bunch of check boxes in your mind. But I have become more comfortable with less research and trusting my intuition a little more. But I would equally say that you can only trust your intuition when you've actually honed it for a very long time. Yeah. Like a musician on stage, just like a jazz musician. I just get up there and play. I trust my intuition. Oh, really? I think I'll do the same. Oh, hold on, kid. You better go learn the trumpet first.
Yes. Right.
So like, yeah, to I suppose being more distinct, I read until I'm happy to answer this question. I would take $10,000 from my auntie and invest in this business for her. I would take someone else's money and there might be check boxes in my mind, but I don't need to research. If I broadly think a business has an addressable opportunity, they're making headway, they're growing revenue, and they've got a and they're doing things well, I will get to a point where I'm satisfied.
So you're saying it takes exactly as long as it takes?
Yes, it does. It does. But I do watch a business for a long time before I absolutely pull the trigger. But doesn't mean that I'm every day trolling the internet or looking at X saying, right, what's everybody saying? It will exist in my consciousness for a while before I jump.
All right. Emmet Savage, my friend, this was wonderful. Thank you for joining us on the show.
Great.
Jason and Jeff, thank you so much for having me. It was a pleasure. Hopefully you'll have me back another time.
Oh, yeah, I'm sure we will. Once again, Emmet Savage, co-founder of My Wall Street. Easy to find him on Twitter. Look in the description of this episode. Look in the transcript. You'll be able to find him on Twitter. Go in the App Store, find My Wall Street, download the app, check out his podcast. You can find all of that right there on his Twitter. It's super easy. Let me send us home, Jeff. We'd love to give our answers to these hard investing questions, have great, successful investors like Emmet come on our show and give their answers. But you got to come up with your own answers, people. No borrowed conviction here. But I believe in you. You can do it. All right, Jeff, we'll see you next time.
See you next time.